In 2022, a recession is anticipated to emerge from the cost of living crisis. Even while we aren't currently experiencing a downturn, there are certain strategies for investing in one, so you might want to be ready in case things start to change. What is a recession? If a nation's GDP has decreased for 2 consecutive quarters, that nation is said to be in a recession. How will a recession affect my finances? Recessions can have devastating effects on our incomes and employment. We describe how a recession might impact you and how to safeguard your cash. Investors need to be ready for a bumpy journey. For those who have a long-term perspective, the stock market still presents the best chance of wealth growth even during a recession. Here are the top 10 recession investing guidelines. 1. Remain calm. Avoid having impulsive emotions during a market decline, such as selling investments. You might sell them at a loss and possibly miss out on a recovery, depending on how much you paid for them. The cost of living crisis ambiguity will continue to produce market volatility, so the trick is to concentrate on longer-term objectives and wait to ride out the market's inevitable hiccups. 2. Spread and diversify the risk. Any effective investment strategy must include diversification. Invest in both bonds and equities. Spread out across international markets as well, preventing overexposure to downturns in any one region. Make sure your risk profile is one with which you are comfortable. This is the level of investment value decline you can tolerate while still seeking higher returns. 3. Maintain low costs. All platforms for investing charge fees to manage your money. Typically, there are charges associated with holding money as well as exchanging funds and shares. Verify that you are not overpaying for your assets. The value of your fund will increase if you migrate to a platform with lower charges because platform costs fluctuate. 4. Put money into investments gradually. Timing the market, which entails attempting to acquire or sell stocks at precisely the appropriate time in anticipation of price increases or decreases, is exceedingly challenging. It is considerably more challenging in a market where increasing volatility and investor concern are prevalent. Instead, develop a consistent savings routine and add money gradually. By doing this, you'll make sure you gain from pound cost averaging. In this scenario, you increase your purchases of investment units when prices are low and decrease them when prices are high, causing the price to average out. 5. Make sensible investing decisions. If you are directly investing in stocks, seek out companies with robust balance sheets and business plans. You want to look for businesses that sell consumer essentials like supermarkets where demand for the good or service is mostly unaffected by the state of the economy. Additionally, you might wish to put money into industries that will grow no matter the financial environment. 6. Benefit from low-cost stocks. The stock price of investments may remain low with a bleak economic outlook. This suggests that there may be a good opportunity to purchase stocks for a low cost. Some fund managers specialize in seeking out undervalued businesses with strong future prospects. These include respectable businesses operating in industries that have experienced lockout but can weather the storm. 7. Have patience while you await dividends. Although it's not as easy as it once was, investors still have options when it comes to using shares to create income. Even in cases where firms have scaled back or stopped paying dividends, those payments will probably start up again in the future. Search for companies with a lot of cash on hand and no debt if you want to find strong dividend stocks. 8. Search for security nets. Many investors may be considering holding more money in corporate bonds as a safety net against erratic stock markets. When investors lend money to businesses, they are compensated with interest. Because gold's performance is unrelated to stock markets, it is seen as a safe haven for money in other places. Bonds and precious metals can help diversify a portfolio and make sure that your assets are not solely dependent on the performance of the FTSE 100 or S&P 500. 9. Put money into a pre-made portfolio. The ready-made portfolios that are available from many fund supermarkets are designed to incorporate a reasonable variety of investments, including non-stock market assets like bonds and real estate. Many have labels that reflect your level of risk tolerance. There is no agreed-upon definition of what constitutes a balanced or conservative portfolio, so be sure you are comfortable with the risk category you have chosen. You might choose a multi-asset fund with a professional fund manager that offers everything under one roof and promises diversification. 10. Find solace in the past. Economic gloom does not endure a lifetime. You should be able to profit from the market rebound if you have an investment horizon of 5 years or more. The Barclays Equity Guild study shows that since 1899, over 76% of all 5-year periods have seen shares outperform cash deposits in terms of returns. Now, the question arises during a recession: what should I invest in? In a downturn, assets that are not heavily indebted tend to do the best. In other words, their debt-to-asset ratio is not high. Companies that have too much money invested in uncertain ventures face the danger of failing. Choose businesses whose operations are not influenced by the state of the economy. What investment is the most secure during a recession? A common strategy to invest at any time, but particularly so during a recession, is to select funds that track stock markets like the FTSE or S&P 500. With index funds, you place your bets on the long-term success of multinational corporations rather than on specific companies. That's it for today. We will be back with another informative video. For more updates, subscribe to our channel.